Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So the winter of 1977-78 was the fourth snowiest on record in Lexington, Kentucky. I was 10 years old at the time. I turned 11 in the middle of that winter. 32 inches of snow fell between December and February that year, with over 42 inches for that entire winter season. To put that into context, on average, Lexington gets about 14 and a half inches of snow in an average winter. So more than double the average in the winter of 77-78. What was really crazy is that we missed virtually the entire month of January from school. We went back after Christmas vacation for one day, had a major snowstorm that night, didn't go back to school until January 27th. I remember this so specifically because January 27th happens to be my birthday. So got to celebrate my birthday at school. Snowed again that night, and we missed a good chunk of February as well. Not a fun spring that year when we had to go to school an extra 2 hours every day to make up the time. But that was life. So go to the year before that, so 76, 77, also a very snowy winter for Lexington, Kentucky. There was about 24 inches of snow that year, so about 10 inches above that average. Now, here's the thing. Remember, I was 9, 10, 11 years old in this time span. I thought this was normal. So I spent most of the rest of my school life mad because it wouldn't snow. I thought we were supposed to get 42 inches of snow every winter. And so then, when I was a junior in high school and we got 5 inches of snow that winter, it was just weird to me. I couldn't wrap my head around it. I thought, well, what's wrong? Why is it not snowing anymore? Well, the fact of the matter is, those blizzardy winters were out of the norm, and less snow was the norm. So I have a point here. This actually has something to do with investing and finance. It shows how our own personal experiences can skew our perception of reality. We have to be aware of this, and we have to understand that our perception does not necessarily reflect reality. And I think that this is a phenomenon right now that is rampant in the financial world. We have an entire generation of analysts, financial reporters, investors, economists who believe that 0% interest rates are normal. And they aren't. So I want to dig into this a little bit because I think that we need to step back and take a longer view of things than, just a year or two, or, even shorter, because I often will say that I think that the world of finance tends to run on, 30-second sound bites. Whatever was a headline on X a few minutes ago, that's what's driving the markets right now. And it's not that those, immediate events aren't important. It's just that you need to put those into a broader historical context. I had the privilege of interviewing Jordan Roy Byrne yesterday. That interview will run on Friday for our Market Wrap podcast, so you'll want to check that out. But Jordan is a really good technical analyst who looks at what we call secular trends, long trends. He's comparing what we're seeing in the gold market right now to things that we saw in the early 1970s. So this is really important because we need this longer view to really understand what's going on. So I want to dig into this a little bit, but before I do, I want to thank you, as always, for taking a little bit of time out of your day and listening to this show. I know there are all kinds of things that you can listen to, so much vying for your attention. So I appreciate the fact that you spend a little bit of time with me. if you would be willing to do me a favor, I would really appreciate it if you would share these episodes on your social media feeds. If you would take a few minutes and write a little review wherever you listen, whatever your podcasting platform is. That will help grow the show. It will help spread it. Just cost you a little bit of time. And, in return, I'll say thank you. My thank yous are very valuable, right? But in all seriousness, I do appreciate all of you folks out there listening, and do hope that you'll help spread the word and let the show grow. So let's talk a little bit about some interest rate history and kind of put things into some perspective. So after the 2008 financial crisis, the Federal Reserve embarked on nearly a decade of extraordinarily loose monetary policy. And this not only incentivized the creation of a debt black hole, which I talked about in last week's show. You'll want to go back and listen to that if you haven't already. It also introduced all kinds of malinvestments in the economy. And it also warped expectations for the future. As I've already mentioned, we now have a generation of people working in and reporting on the financial sector who have no clue what a normal interest rate environment actually looks like. And this warped perception of financial reality, I think, is leading to even more monetary malfeasance. People are wanting to return to a normal that isn't normal, right? So, just how abnormal was this? Well, between the Great Recession and the pandemic, the Fed ran 4 rounds of quantitative easing, and it injected nearly $9 trillion into the economy. So quantitative easing, this is when the Federal Reserve buys U.S. Treasuries, mortgage-backed securities out on the open market. It puts those on its balance sheet. That's why the Fed balance sheet grows. And it does this with money created out of thin air. It literally writes a check from an account that has no money in it. So when the Fed writes the check, the money, poof, it appears. And this money is injected into the financial system. So this is extremely inflationary. So nearly $9 trillion in quantitative easing over those 4 rounds after the Great Recession and then during the pandemic. Now, along with that, it also slashed interest rates to zero for the first time ever back in 2008. And rates didn't lift off of zero until December 2015, 7 years later. We had 7 years of 0% interest rates, 7 years of bonds yielding less than zero. When you calculate the real interest rate, when you factor in inflation, there was all of this paper, not just in the United States, but around the world, trillions of dollars of negatively yielding bonds. Again, not normal. Okay, so by 2018, the Fed had only managed to push interest rates back to 2.5%. That's a decade after the financial crisis and the Great Recession. 2.5%, that's all they got to. At that point, the economy went sideways. If you remember back to 2018, that fall, the stock market crashed. And by 2019, the Fed had cut interest rates 3 times. It ended balance sheet reduction. It abandoned all efforts to normalize monetary policy. And this was before COVID reared its ugly head. And I think that's important because a lot of people, I think, kind of believe, well, things were going along fine and, we were recovering from the Great Recession. Then we had this pandemic and then the Fed had to, it was an emergency and we had to do all of this monetary policy again. But that's not what happened. The Fed was doing easing before COVID, an entire year before COVID. The pandemic gave the central bank an excuse to slash rates to zero again. I think the pandemic kind of bailed out the Fed, right? Because all of the malfeasance from the Great Recession was starting to bubble up in the economy. Those consequences were starting to manifest. And so the Fed was trying to blow air back into the bubble even before the pandemic. The pandemic allowed them to do that. It gave them the excuse to go back to zero and crank up the money printing machine again. So it did. And it wasn't until March 2022 that the Fed finally started aggressively pushing interest rates higher. And that was the point where the Fed could no longer pretend that inflation was transitory, right? They tried to convince us of that for months. And then when that became obvious that that wasn't true, well, they had to relent and begin significantly, or at least comparatively speaking, significantly tightening up monetary policy. So after the pandemic, during the last bout of inflation, the Fed ultimately drove interest rates all the way to 5.5%. Now, most people perceive this as a high interest rate environment, given the decades of artificially low rates, right? When you have 0% for 7 years, and then you go back to 0% for another couple of years during the pandemic, 0 starts to feel normal. 5.5, that's a lot. But from a historical standpoint, that 5.5% peak that we got to during this hiking cycle is actually slightly below the historical average of interest rates. If you look at a chart of the Fed interest rate policy, and I'll put one on the show notes page if you want to check it out. That will be over at moneymetals.com/news. The federal funds rate peaked just above the level of the 2006 peak a couple of years ago. But prior to that, rates were much higher, going all the way back into the 1960s. And when you look at a graph, you'll also see a general downward ratchet effect in rates over time. So you'll see this kind of cycle where the Fed lowers rates, and then we have a boom, and then the Fed tries to raise rates because inflation gets hot, and then we have the bust, and so the Fed has to lower rates again in order to deal with the recession and the effects of the bust. And every time that we have the bust, the Fed has had to push down interest rates lower and lower until finally in 2008, it got to 0. And that's ultimately why the central bank went to quantitative easing because, you're at 0. The U.S. central bank has been very reluctant to do negative interest rates where the bank's actually paying people to lend out money. So instead, the Fed has gone with quantitative easing. Now, in Europe, we actually did see negative interest rates, which, again, not normal. But today, because we did it, a lot of people think, it's just a normal tool in the toolbox, so to speak. So really what I'm getting at here is in effect, the economy needs bigger doses of the easy money drug to reinflate the bubble each time through the cycle, right? It's just like a heroin addict. The heroin addict needs more and more heroin to get the same high. You build up the resistance. Our economy has built up a resistance to the easy money drug. So it needs more easy money every time that there's a crisis to kind of pull the economy out of the crisis. Now, here's the question. At what point does the amount of drug necessary cause an overdose instead of making the addict high? We don't really know, but I have a feeling we're getting close to that point of no return. When you start seeing 0% interest rates for 7 years, that's a pretty hefty addiction, right? So I think the most notable aspect of the chart that I mentioned is that nearly 10 years of 0% interest rates following the 2008 financial crisis. This is the real outlier if you look at the chart, right? However, again, we have millions of people who work in the financial sphere who have never experienced a normal interest rate environment during their careers. So they imagine that 0 is closer to the norm than 5.5%. Right? Think about it. If you were 20 years old during the 2008 financial crisis, well, today, you're almost 40. So you're kind of getting into your career. So that's the kind of the point that I'm making here. All of these folks, they have this narrow view of history that they perceive as being normal. The perception is not the reality. Right? And we see the same disconnect between present perception and historical reality when it comes to mortgage rates. Okay? So right now, the interest rate on a 30-year fixed mortgage was running around 6.3% as of mid-November. I didn't look to see what it was today, but it's probably in that ballpark. It's kind of been in that 6 to 7% range now for several months. And this is perceived as very high. It's not. 6 to 7% mortgage rates used to be the lower end of the normal range. Of course, that was before the Fed started skewing rates downward with interest rate policy and quantitative easing. Now we have 6 to 7% mortgage rates being a big deal because, quite frankly, home prices have exploded by 50% and more in just the 2 years from mid-2020 to mid-2022. So we had this explosion in home prices during the COVID era. Not surprising given the amount of inflation that was produced, right? In those 2 years, the Fed was doing what, $4 or $5 trillion in quantitative easing. So that is, by definition, inflation, and that inflation manifests in the economy. Now, we always think of inflation as being consumer prices, right? You go to the grocery store, prices go up, that's inflation. That is one symptom of inflation. Consumer price inflation is one result from this monetary inflation. But it also inflates other things. It inflates the stock market, right? It's an asset inflation, and it inflates housing prices. So this policy has blown up the price of houses, and then we have interest rate policy that has pushed mortgage rates up to 6 or 7%, which now seems high in the face of those high home prices. Now, ironically, it was Fed policy that blew up the housing bubble to begin with. You know, it's almost as if they learned nothing in the run-up to the subprime crisis and subsequent financial system meltdown in 2008. It's the same thing, right? After the dot-com bubble popped, the Fed cut rates, didn't have to go all the way to zero. They went down to like 1.5%, which at the time was the lowest ever. And it created a crazy housing market that eventually collapsed. Right? Wolf Street, I think, summed up this really good. Quote, the home price explosion, and he's talking about the most recent one, was a result of the Fed's reckless monetary policy that created 30-year fixed mortgage rates below 3%, while inflation had begun to rage and was heading to 9%. The Fed, with its reckless policies, orchestrated negative real mortgage rates of minus 3%, minus 4%, and even lower, better than free money. And when money is free, buyers' brains turn to mush and prices don't matter. And then the music stopped. So in other words, when you had these real mortgage rates that were negative, you were essentially getting paid to borrow money. That allowed all of these investors to go out there and buy a bunch of houses, right? Supply and demand, that demand went up, the prices went up. So this monetary policy, it fuels all of this. Whenever you hear about the Fed trying to fix inflation or rescue the economy, usually it's trying to fix things that it broke in the first place, right? But all of this provides some insight as to why the Federal Reserve is intent on cutting rates now, despite sticky price inflation. I said this last week, in a sane world, the Fed would be holding rates higher, maybe even hiking interest rates right now instead of cutting rates into this inflationary environment. But to some degree, it's just a matter of necessity, right? After decades of low rates, multiple rounds of quantitative easing, the economy is addicted to easy money. A debt-riddled bubble economy simply can't function in a normal interest rate environment. And ladies and gentlemen, where we are right now is normal, at least from a historical standpoint. In fact, it's the low end of normal. But the economy needs more of the easy money drug, so normal isn't good enough. The Fed basically had a choice. It could keep the air in the bubbles, keep the easy money going, try to drive down those interest rates so that the government can keep borrowing. It could do all of that, or it could deal with the inflation problem. The Fed picked the bubbles and it surrendered to inflation. Part of it is necessity. Part of it is just this perception that interest rates are too high, but this is the reality of that policy. And I also think that the expectation of loose monetary policy is something of a self-fulfilling prophecy. As long as people think low rates and money printing are the norm, you're not going to find a lot of resistance to this monetary malfeasance. And after decades of easy money, it seems normal, right? Again, it's a classic case of perception shaping reality. But again, perception is not reality. The easy money world we live in is not normal, and imagining that it is won't change the negative impacts that are coming down the pipe. So here's the thing, folks. Gold and silver are reflecting this reality. The relentless devaluation of our money makes metals seem more expensive. In fact, they're just preserving our wealth. As the dollar and every other fiat currency out there depreciates, it takes more of that fiat money to buy an ounce of gold or silver. So it's not so much that the cost of gold and silver is going up, it's that the value of your money is going down, and it's being reflected in its relationship to real money, gold and silver. And this is why I say over and over again on the show, if you're saving money, you don't want to do it in dollars, you want to save in real money, gold and silver. So speaking of the devaluation of your money, did you hear that the Philly Mint recently struck the last 5 pennies? Yep, the penny is no more. No more pennies are being made. You know who killed the penny, right? It was the government. And, it was tantamount to shooting the messenger. So the Treasury stopped mass producing pennies months ago after President Trump passed a death sentence and ordered the end to the venerable 1-cent piece earlier this year. However, after the mass production ended, an unspecified number of pennies were struck with an omega symbol on them, signifying that they're the last of their kind. And the final 5 pennies produced in Philly last week were part of that batch, and they're going to be auctioned off next month. U.S. Treasurer Brandon Beach actually showed up in Philadelphia to witness the final execution. So Trump passed the death sentence on the penny in an announcement way back in February. And at the time, he cited the rising cost of manufacturing the 1-cent coin. Trump said, quote, "For far too long, the United States has minted pennies which literally cost us more than 2 cents. This is so wasteful." And Trump went on to say that he's going to rip the waste out of the U.S. budget, even if it's a penny at a time. So how much does it actually cost to make a penny? Trump is right. Actually, he understated the situation. According to the U.S. Mint, it costs 3.69 cents to mint and distribute 1 penny. So in 2024, the Mint produced 3.2 billion pennies, and it cost about $85.3 million. That was over half of the new coins that were minted last year. So a lot of pennies, not going to have them anymore. What happened to the penny? Well, the fact of the matter is it's not worth anything anymore, right? I mean, I guess you can still give a penny for your thoughts. That's about it. You can't even get a penny gumball anymore these days. 1 cent has become virtually irrelevant in today's financial system. The greenback, the dollar, has devalued so much that the value of 1/100th of a dollar is approaching 0. It's worth about as much as the lint that's in the pocket with the penny. So how did this happen? Well, we've talked about it before on this show. The government is destroying the value of your money. Simply put, the government and its enablers over at the Federal Reserve have printed the dollar into oblivion. And the more dollars they create, the less each dollar is worth. And folks, they have printed a lot of dollars. Since 2008, I've mentioned this already, the Fed has created over $8 trillion through quantitative easing alone. And the results were predictable. Based on the CPI, get this, prices have increased by over 713% since 1970. That penny gumball that you bought as a kid now costs about 8.1 cents today. And keep in mind that CPI that we're talking about, it doesn't tell the entire inflation story. I mention this every time that I talk about the CPI because I think it's extremely important. The government revised that CPI formula back in the 1990s so that it understates the actual rise in inflation or the actual rise in prices. If you go back, and you can do this, you can use the formula that they had back in the 1970s. And when you do, you'll find that the CPI is actually closer to double the inflation numbers than what they're talking about. And I would imagine that 1970s CPI formula probably understated price inflation as well. But that's the number that we have, so it's what we use. Nevertheless, it's important to understand that when you hear these CPI numbers come out of the government, they are actually understating inflation. So on the other side of the coin, and yes, the pun was intended since we're talking about pennies, production costs have gone up for the penny. And that's due to the same inflationary pressure, right? Everything costs more. Materials, production, all of that costs more money because of inflation. So you have a deflating penny and inflating production costs. So when you put it all into perspective, it's no wonder it costs so much more to produce a penny than the penny is worth. The bottom line is, every time you pick up a penny, it's a reminder of Uncle Sam's monetary malfeasance. And instead of actually solving the problem, i.e., in the borrowing and spending and the money printing, your drunk uncle just shot the messenger and sent the penny to its grave. Not going to remind us anymore of the devaluation of our money, you silly penny. And, obviously, this isn't the first time that the government has taken steps to obscure its monetary destruction. Go back to 1982. That was when the U.S. Mint removed most of the copper from the penny. Before that, pennies were composed of 95% copper, 5% zinc. But copper's expensive. And due to those rising copper costs, again, the result of inflation, the mint changed the composition to 97.5% zinc with only 2.5% copper plating on the penny. So it basically devalued the penny in 1982 before it got rid of it this year. The government devalued silver coins nearly 2 decades earlier. I've talked about this on the show before. Under the Coinage Act of 1965, signed by good old President Lyndon B. Johnson, the U.S. Treasury removed all of the silver from dimes, quarters, and half dollars. So today, the government mints these coins from composites. Basically, it's the same alloy that's used in the nickel, and it's bonded to a core of pure copper. So it's funny, and I say this all the time too, you will sometimes hear people call coins that were minted before 1965, these silver quarters, these silver dimes, these silver half dollars, they call it junk silver. I don't know why, because that's not junk. The new stuff is junk. We should call the modern American quarters junk, not the old stuff, which is actually silver, real money. And the demise of the penny is just another example in this same phenomenon. It's just another link in the chain, right? It's this constant devaluing of money. They have to do it. So when Johnson signed the Coinage Act, he actually insisted that removing the silver would have no impact on the value of U.S. coinage. He said, quote, "The Treasury has a lot of silver on hand, and it can be and it will be used to keep the price of silver in line with its value in our present silver coin," he said. Yeah, right. And just a few years later, President Richard Nixon made a similar claim when he cut the final tie to the gold standard. He delinked the dollar with gold. And he said, quote, "Let me lay to rest the bugaboo of what is called devaluation." Bugaboo. And he promised, "Your dollar will be worth just as much as it is today." Oh, whew. Both men were lying, right? And, I guess you could be generous and say, oh, they were just mistaken. They really did think that the dollar would retain its value. No, they didn't. Not if they understood anything at all about money, right? Because devaluation is part and parcel with the fiat money system. So, today you'll see a lot of stores, they have those take a penny, leave a penny dishes. And nowadays, you'll actually see a lot of nickels in those trays, and sometimes you even see dimes. Think about this. People are literally just leaving money on the counter. Now, would you leave a $100 bill on the counter? No, you ain't doing that, right? That's because $100 can still buy something. Penny can't, so why not put it in the dish? An economist told CNN, quote, "When people start leaving a monetary unit at the cash register for the next customer, the unit is too small to be useful." Right? It's not useful because it won't buy anything. We don't need pennies. They're basically just filler. here's the reality. Here's what I'm driving at here. When you disconnect money from anything tangible, it's going to quickly depreciate. It's as certain as death and taxes. And it's exactly what has happened. This currency debasement is ongoing. They killed the penny. What goes before the firing squad next? The nickel? You know, the way things are going, it's only a matter of time. And by the way, it costs the government more to produce a nickel than it does a penny. According to the most recent annual report distributed by the U.S. Mint, it costs 13.8 cents to produce and distribute one nickel. So are we going to get rid of the nickel soon? I don't know. But this again, I'm going to say it again. This is why you want to have real money, right? You don't want quarters or dimes. You want 1964 quarters and dimes that have 90% silver in them. Now, you're going to have trouble finding those silver coins out in the wild because people have hoarded them. But you can actually still get them from Money Metals. And we're running a special right now. You can get junk silver, these quarters, dimes, half dollars that are 90% silver. You can get these for under spot right now. It's the most economical way to get silver. And I would argue that even though silver right now is $50 an ounce, it's still a bargain. You know, when you look at the gold silver ratio, when you look at the shortfalls in the silver market. I just did an article that I published over at moneymetals.com/news this week about how the silver market is on track for another supply deficit. So silver still has a lot of upside to it. You can get junk silver over at moneymetals.com. And you can pay under spot. So something to think about, something to consider if you're interested in getting silver. Or hey, be kind of a cool gift for your kids, you know, as we get into the Christmas season. Get them a bag of junk silver and, explain to them the devaluation of money and the value of that silver. It's a great lesson, and it'll give them a little bit of a savings that is not going to devalue as the federal government continues to print away the value of your money. But again, you want to have real money. You want to have gold and silver. It's not going to be devalued by government action. It will hold the value of your wealth over time. It is the hedge against what I like to call monetary malfeasance. And it's not going to stop, right? We've already discussed the fact that we have this debt black hole, and we have a situation where the Federal Reserve has no choice but to pivot to easier money, even though we still have inflation. It's not going to end. I say this all the time. It's not a policy that you can vote away. You can't wish it away. All you can do is try to navigate it as best you can. So now is the perfect time. Talk to a Money Metals, precious metals specialist. Call 800-800-1865 today. I say this all the time. These folks are fantastic. They're knowledgeable. They're happy to answer your questions. If you have just even basic questions about investing in gold and silver, these folks can help you out. And of course, I know a lot of people don't really like to talk on the phone. You can actually chat online. Go to moneymetals.com. You can chat with the precious metals specialist there. Or if you don't want to chat at all, you know what you want. You want to get some of those junk silver quarters and dimes and nickels. You can just go to moneymetals.com, order what you want. We'll ship it to you. Or you can have your metals stored for very low cost in our state-of-the-art bullion depository facility in Eagle, Idaho. So do it today. Don't wait, right? This situation isn't going to change. You can't sit back and, maybe next week the government will stop devaluing our money. That's not a thing. This is the world we live in. So do it today. 800-800-1865. And with that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, you can sign up, get on our email list, join over 1 million people who have signed up for that list. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform if you haven't done that already. And when you do, you can also tune into our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with interesting interviews between yours truly and folks in the world of gold and silver, economics, and investing. So again, thank you so much for listening to the show. I really appreciate it. I hope you have a fantastic rest of your week. And I will be back again behind this wonderful microphone next week.